Securities and advisory services offered through Centaurus Financial Incorporated, a registered broker/dealer member FINRA, and SIPC, a registered investment advisor. Centaurus Financial Incorporated and Spivak Financial Group are not affiliated.
All right, well, welcome back, everybody. This is Wealth Wisdom with Stuart J. Spivak. Stuart is the senior managing partner at Spivak Financial. You can reach him at 480-556-9931 or simply going to spivakfinancial.com. And right from that website, you can schedule a time to meet with you personally.
Yes, sir.
We get to be on with you, live and direct.
Here we are.
Here we are.
Thank you for having me.
And we are in Scottsdale, height of summertime.
Mild 110 degrees. That's okay.
There's maybe like, I've known Stuart for a really long time. And there's maybe like 5 times in my life that I haven't seen him without a white shirt and a tie on. But today at 110 or 112 or I lost count.
I mean, this is
today's the day.
Summer attire right here.
I love it.
Golf shirt, just
and a good golf shirt at that.
And a good golf shirt at that. The Masters.
Could it be any better?
Iconic. Bucket list.
And we got to share some time there at the Masters together.
Special place for sure.
Oh, it's the best.
Yeah.
It's the greatest place. We're in a pretty cool place too, which we get to sponsor Phoenix Open, Waste Management. You always have a client event, kind of the kickoff night with the concert going on. It's iconic too.
I mean, it's one of those events that you have to see it to believe it. And, when they say that the Waste Management Open is the largest outdoor cocktail party on the PGA Tour,
They're not lying.
They are not lying. This is a sight to be seen. And you do have to see it to believe it. And it's almost like the Masters. The television does not do it justice.
Right.
You know what I mean? You have to see it to experience it. And it's the same thing, in our backyard here in the Phoenix area. So, yeah, that event is pretty awesome.
Well, about 3 weeks after the tournament, my son and I went and played TPC Champions.
While it was all up, while all the stands were up and everything.
And I will say I did birdie.
16?
I birdied 16.
That's iconic right there.
It was a big dad
I wish I was out there cheering.
Carson.
Yeah, I bet.
I bet it would be a little different with everybody else in those stands, though.
I would say so. Little intimidating.
Well, speaking of intimidating, it seems like headlines, gosh, every time you turn on the news, you go outside in the morning with your cup of coffee and pick up your newspaper. All right, maybe we don't do that anymore. But any news that you turn on, it's they're selling headlines, man. It's inflation, elections, interest rates, wars, tariffs, gosh, you name it. And it gets people freaked out. And gosh, your phones must be ringing all the time off the hook with people worried. I mean,
look, I wouldn't say our phones are ringing off the hook, and they never really have. When we do go through volatile times in the market, the analogy that I like to use is that of an airline pilot, right? It's the airline pilot's job to take off safely, a dangerous part of the flight, and then to land safely at your destination, right? It's really what our job is, right, as financial advisors, is to help clients who are about to retire or already retired, right, to take off safely during that next chapter of their lives, and then to land safely at their destination, right, making sure that they're going to be financially secure for the rest of their lives. Now, like a pilot flying, whether you're flying from Phoenix to Philadelphia or wherever you may be going, that doesn't mean that the pilot's not going to come over the loudspeaker and say, ladies and gentlemen, I need everybody back in your seats. I do need you to buckle your seatbelts. We're getting ready to go through some turbulence. Mm-hmm. Now, is it the pilot's fault that there's bad weather ahead? No, it's the pilot's job. Is it my fault that the markets are volatile and wars going on and inflation and all the headlines as you talk about? No, it is our job to help navigate, the current times and to remind our clients that they have a very thoughtful plan so that they can sleep well at night and know that these volatile times, more times than not, create an opportunity, okay, a buying opportunity many times, not a not a time to panic.
Yeah. Yeah. How do you settle down? I mean, it seems like, gosh, if you pull back whatever market sequence of time, there's always feeling of volatility. There's always feeling of uncertainty. So what's your advice as people look on, turn on the news, they see this stuff. Oh my goodness, what's to come? How do I maybe time this for those investors that are more kind of like, how do I take advantage of this? Like, what is your advice? How are you walking people through times of uncertainty?
I mean, look, after 38 years in this business and industry, there are certain principles, that we've learned and that all financial advisors hopefully have learned. And that is that, look, day one in the financial planning world is that most people don't plan to fail. They simply fail to plan, right? I mean, very, very, apropos, if you will. But what I believe very strongly when we're talking about the stock market as an example is that the long term is inevitable, the short term is unknowable. So the people that get themselves into what's going to happen next week, next month, what should I do? Which, by the way, when you turn on CNBC and all these, financial channels, they are essentially financial pornographers, if you will, because they are talking to people as if they should be day traders, right? When is the best time to get in and when is the best time to get out, which is nearly impossible, right? You always have to be right twice, right? When do I get in? When do I get out? When do I get back in? I mean, it's a very, very difficult game. So when you know that the long term is inevitable, okay, the short term is unknowable, it allows you to think through how to best set up a plan for somebody so that they don't have all their eggs in one basket. They essentially could have an income plan and a growth plan, right? And if you have enough income coming in and you know that you're not going to need the money that you have earmarked for growth, essentially to replenish that income bucket in the future, it should allow people to sleep very well at night.
Well, what I've learned from you, amongst a ton of stuff that I've learned from you, the diversification and getting those eggs properly balanced in that basket all comes back to that person's plan. And I know you preach this all the time, but it isn't about a one size fits all.
That's right.
It's about your situation. So here you go. Here you are as an advisor. You can help people in every aspect of financial services. There's nothing you can't do. Gosh, you've written a book in your background. You've written a book around life insurance. Like you're a knowledgeable guy to put that together. It's about aligning those pieces that come back to that plan.
I mean, look, you hit the nail on the head, and it is about having the plan. And, when I do public speaking, which I do a lot, I know you do as well, that there's only three things that can happen during the course of our lifetime, you, me, and everybody we know, and that's live too long, die too soon, or become disabled, right? And sometimes, that become disabled might happen before we all eventually pass away, right? But living too long is obviously the number one concern of a retiree today, right? Making sure they're not going to outlive their money, right? So we want to make sure that our clients have a plan for lifetime income. If they die too soon, we want to make sure that there's a plan in place when we know that one spouse is going to take a pay cut when husband dies or wife dies, and there's a pension and there's Social Security benefits, and we want to make sure and understand what that impact will be when a death occurs. And then, look, a disability, a long-term care event, the subject that nobody wants to talk about, right, is really what could, really destroy a well-thought-out plan. Because the cost of care today, we used to use a number of $200 a day for care today. That's $6,000 a month. That's $72,000 a year of after-tax dollars, right? That means basically $100,000 a year minus 28% taxes. That allows you to write a check for $72,000 or $6,000 a month. But that number is closer to $300 a month now when we look at, the major cities in our country. That's $9,000 a month, round numbers. That's $108,000 a year of after-tax dollars. So the question we ask everybody is, what's your plan, right? And most people have what we call the no plan. It's a plan, and it's not a good plan, but they're just, saying a prayer and hoping that this is something that they won't have to deal with. And look, we want to be proactive with those things and have those conversations.
It's funny, you and I have talked about this in the past, but it's like how many times we've done an event where you and I have shared this stage together, then people immediately book on your schedule. They want to come in because we've triggered whatever it is with them, and they want to come in and get that review, and they walk in with a bunch of statements like, hey, bring in your plan, let's take a look at it. And the plan is a bunch of statements. That's not a plan either. So we're talking about things that can derail one's plan or one's retirement and totally alter. Here's a sensitive subject. We can derail our plan.
That's right.
And tremendous amounts of research has proven time and time again that we actually, as investors, hinder our overall rate of return. Why? Because when the market's really, really great, and sometimes we get greedy and we keep investing, and then the market goes down, so we panic, so we sell, and then the market starts to come back up, and we're not quite ready to reinvest and catch the wave. And so by waiting, sometimes that can really hinder our rate, our overall rate of return. It's us. It's greed and fear that can hurt us. So you were actually talking about some stats kind of showing if people had $100,000 to invest and they didn't try to time the market, they didn't have to panic, going back to a period of time, how that changes. And by the way, if they just missed just a few couple of the best days, what a change that is. Kind of walk us through that.
I mean, look, it's the impact of being out of the market, right? Yep. And the reality is like I said, the short term is unknowable. The long term is inevitable. As we sit here today, the conflict, to say the least, with the United States and Iran, you still have the Russia-Ukraine situation going on. Israel and Hamas is obviously part of our whole conflict with the United States and Iran. And if you would have told me that the markets would be trading at all-time highs, I would have said that's probably not going to happen. Okay? So it's an unknowable. That's the short term. I pulled out this chart just to look at to get the most updated numbers. But if somebody had $100,000, okay, we're going back 20 years, 2006 to the end of last year, 2025, and they just let that money sit, and we're talking about the S&P 500, the broad market, right? At the end of basically 20 years, that $100,000 would have grown to over $548,000. Now, if you just missed the 10 best days, okay, and by the way, that 20 years in the market would have averaged just shy of 9% average per year, 8.9%. But if you have just missed the 10 best days, now think about it for a second, over 20 years, if there's 50 trading,
it's a lot of days.
If you're talking about 5 days a week and the market's open basically 50 weeks a year, that's 250 trading days a year. I don't know the exact number. Times 20 years is 5,000 trading days over 20 years. If you missed the 10 best days, okay, you didn't earn 8.9%, you only earned 4.6%. But instead of having 548,000, you'd only have $244,000. Major, major miss. God forbid you missed the 20 best days. I'm talking about 20 days out of 5,000 trading days over 20 years. You didn't earn 4.6%. You only earned 1.8%. I'm not even going to tell you after 30 days, the best 30 days out of 5,000 days, okay, is basically a negative. You're better having your money under your pillow.
Crazy.
Okay. So the reality is that you need to make sure that you have a plan. We are making sure our clients are not gambling. They're not speculating with the market. We have a well thought out asset management plan that allows our clients to sleep well at night, that has proper diversification, and that has the ability to smooth out the ride at times like this, right? When we went through the conflict earlier this year and the market pulled back big time and clients were questioning, what should I do? Should I get out? I saw iconic companies that have went on sale. I don't know about you. I know you love Nordstrom's. If you went to Nordstrom's and you saw your favorite golf shirts, okay, that you buy all day long at retail, and you show up back at Nordstrom's and they're selling now for 25% off, do you not like them anymore?
I mean, I'm buying up as much as I can.
I would argue that you should buy some more at 25% off. We call that dollar cost averaging.
Yep.
So again, that is really where opportunity presents itself, when people are thoughtful. And before you comment, I mean, the analogy I want to bring up, and I find this interesting because we have a lot of clients that own investment properties, real estate, right? What you don't do if you own investment property is you don't go to Zillow every day and check the value of your property.
No.
Okay? Because really it does not matter until you want to sell it one day, right? But the stock market is in everybody's face and is on everybody's, handheld, iPhone or smartphone, and everybody's looking every day. It's up, it's down, it's up, it's down, it's up, it's down. And it causes people, especially on the local news, market's up, the market's down, the market's up, to make short-term decisions. And back to what you said, the headlines tell a story and they spook people, usually unnecessarily.
Yeah, so volatility isn't something investors should fear, right? If you have a plan and your plan's built and you understand the risks, because you're not talking about de-risking and getting out of the market, it's making sure that each one of those, again, eggs of the basket have purpose, have reason, and is built so that you can do those things. If you have the other eggs in the basket that are built to do things like have the correction protection like you talk about, have the income for life, have that sustainability, that allows you to be really proactive or consistent in your risk bucket, right?
I mean, look, our clients know, and I'm going to be talking a lot more about this in the months ahead, which is election protection.
Okay, I like this.
Because, we do have a midterm election coming up, and that is sure to be, very volatile, to say the least. And, I have always been of the opinion, and my clients would tell you this because I say it all the time, better to have protection and not need it than need it and not have it. I just think it's very important for clients to have some portion of their portfolio that is protected without necessarily sacrificing returns, but to have protection. And the financial services industry has created products and vehicles and, different investment options for people that allow people to have the protection to make them sleep better at night. So again, it's all about a well thought out plan like you're talking about. We don't make a one size fits all recommendation to our clients. We want to understand what their goals are, what their objectives are, what their time horizon is. Being a fiduciary financial advisor for the past 38 plus years now, it is our duty and obligation to always put our clients' interest ahead of our own. And of course, we've always done that. That's not only, good business, but that's just the right thing to do. But it starts with understanding what our clients' goals are, right? And we, at the end of the day, are trying to find problems to solve, not products to sell,
Right.
right? When you understand the problem, okay, and what people are trying to accomplish, then we can make the appropriate recommendation.
So, how often are you telling people to really take a look at their plan, pull it out, touch it, feel it, measure it, make sure it's on track? Like, how often are you getting together with clients or even suggesting clients really get to review those policies,
Look,
review those plans?
at the end of the day, we want to meet with our clients a minimum of once a year. We're obligated to do that. But we ask our clients at what tempo they would like to meet. Okay. I personally think quarterly is a little overkill. So it might be 4 times a year. It might be 3 times a year. For some of our clients, it's semi-annually. Twice a year we have a check-in. But it really is based upon our clients and what, is important to them. There are some years where we might, have 10 meetings with the client. If there's an illness happening, if a death occurs, if there's some extenuating circumstance. And in a normal year, it might be anywhere from 1 to 4 times a year, depending upon the particular client.
Well, I love that you just constantly educate. That whole knowledge is power. You got a whole series of educational events coming up for new investors to come in, sit down, meet with you. What are some topics coming up that you think people need to know about coming into this fourth quarter? You kind of talked about election and some of that. What's going to be? Give us a look under the hood a little bit.
Look, at the end of the day, when you talk about big themes, I think having protection, election protection coming up. We've talked for years about having correction protection,
Yep.
again, without sacrificing, returns, if you will. I think taxes are always a hot subject. I believe very strongly the taxes are still on sale right now. So there are some planning opportunities for clients to take advantage of Roth conversions, if you will, tax management opportunities. When we're managing non-IRA money, I would argue that we are some of the best in the business as far as the tax management strategies that we are bringing to our clients. We know that we are saving our clients somewhere between 1% and 3% a year on the tax management side of managing portfolios using direct indexing and other strategies and whatnot. And, it's real money. It's real money.
It's real money.
And taxes are, not going down. Okay. I haven't met anybody that feels that tax rates are going down in the future.
I don't think so.
Right. So we want to be very proactive. You would see on our website, we talk about disinheriting the Internal Revenue Service. I am a big fan of disinheriting the IRS and how can you and our clients keep more of their hard-earned dollars and give less to the tax man.
That's what it's all about. I want to leave everybody with something that you hit on in a lot of your educational events that I've been part of, which is another type of risk that you can't turn the TV on, turn on to Bloomberg and hear about it. But I think everybody today needs to have this conversation, and that is how sequence of returns risk can truly impact your retirement. So when somebody talks about sequence of returns risk and the impact on one's plan, like how do you kind of illustrate that to somebody? How do you talk to that?
When you are climbing the proverbial financial mountain, when you're still actively at work, you're still adding to your 401k every 2 weeks, you're still building your portfolio, okay? A 20, 25, 30% market correction, okay, is not the end of the world, right? You could argue that it creates an unbelievable buying opportunity, which I just alluded to.
Yes.
I do believe that. But now let's say you're at the top of the proverbial financial mountain. You're now getting ready to retire. You're 62, you're 65, you're 67, you're 70, whatever that number is. and now you've accumulated $1 million, $2 million, $3 million, $5 million or more, and you know you have a certain lifestyle that you need to maintain. You have a certain amount of fixed expenses, okay, and you have a certain amount of discretionary expenses, okay? If, for example, okay, the first year, okay, that you now want to start pulling out money from your portfolio. Let's take somebody with $2 million and they want to start using 5% withdrawal rate. If you're taking out $100,000 a year, okay, and in that first year, the market goes down 20%. Let's do the math, okay? You're now retired, you're 65 years old, you have $2 million, you've been told by somebody that you have enough money to live comfortably the rest of your life. Just buy the S&P 500, look at these amazing rates of return, and you have nothing to worry about.
Yep.
First year you retire, market does not cooperate, it's down 20%. Let's do the math. $2 million, 20% loss is $400,000. You now have $1.6 million. You withdraw 100.
Yep,
You now
'cause I
have
still need income.
You now have $1.5 million. Okay? Let's say the market again the following year goes down 10%. Now your 1.5 million is now lose 150,000. You have $1,350,000, and now you take out the same $100,000 that you need to live.
Yeah, because I
You're
still
2
need
years
income.
into retirement. You now have $1,250,000.
better
I
go
would
back
hate to be
work.
the guy, the financial advisor, that now has to explain to that client that they have no chance of getting back to even, and they are most likely going to run out of money before they die.
Yeah. Yep.
So when individuals are talking to their Fidelity person, their Vanguard person, and they are basically saying, well, look at this fund. It's got a 5-year track record of earning 8% a year, 10% a year, 12% a year, 15% a year, whatever the numbers are. I am here to tell you that means absolutely nothing when it comes to the analogy and the scenario I just painted.
Yep.
The rate of return does not matter when you are withdrawing money and the markets are going down,
Right.
because you're not going to get back to even. It's just a math problem at that point in time. So again, obviously, we visually show this to people so they can understand this, but most, the Vanguards of the world, the Fidelities of the world, the Schwabs of the world, what they are not talking to their clients about is this big elephant in the room called sequence of returns risk when people are about to retire. This is a huge, huge, huge issue and problem.
And by the way, inflation and dare I say the word inflation,
That's right.
and we're living longer, like we talked about already, with longevity risk, and all of that is mounting to really add fuel to the fire. It can go real fast, like you're talking about.
And listen, I mean, look, you know, there are plenty of people in this country that can live very comfortably on $30,000 a year, right? There are plenty of people that can't live on $300,000 a year, right? And I'm not saying one is right or one is wrong, but everybody grows accustomed to a certain lifestyle, okay? And, you know, unless you have a proper plan to make sure that ideally your fixed expenses, the cost to run your household, what it costs to wake up, okay? If you still have a mortgage, if you have car payments, if you have property taxes and auto insurance and gasoline in your cars and food and clothing and shelter, all the basics of life, and whatever that number is, I believe in an ideal plan that should be covered by guaranteed income sources. Then what we have is your paychecks, because I would arguably and say that these are your paychecks, right? You need
Yep.
paychecks to pay your fixed expenses, right? Just like you were paying those when you were actively at work. And then your paychecks is all your fun money, right? I mean, that's your money that basically is for your travel and all your discretionary expenses, right? Added together, that's the income that you are targeting for your retirement, ideally adjusted for inflation because life continues to get more expensive. And again, by making sure that people have their fixed expenses covered by guaranteed income sources, I am here to tell you, and study after study by all the financial institutions show that people that retire with guaranteed income sources are happier, live longer, and are less stressed out versus people who just might have $1 million or $2 million or $5 million in a handful of accounts.
Right.
Okay?
Well,
So,
I think, during times like this, uncertainty, unfortunately, sometimes freezes people in their scenario. They wait and see. Oh my gosh, I don't know what to do. Let me go hide under a rock for a little while. And what I love is right when you go right to your website, one, you can book a meeting, but it's not just any meeting, it's a discovery meeting. And I know that you're strategic with every last word is scrutinized to prove a point to say why we're different. Discovery meeting is important. You really want to get educated. You really want to find out where you are today. Get that financial stress test done. Really learn what's going on. That's what discovery is, right? Let's go in. Let's see if there's good work. I know you always work with good work. Hey, somebody did a great job here.
we never undo good work.
That's
I
right.
mean, if somebody has something that, is solid, we will compliment them and tell them, good for you.
Good.
This is
Yeah,
fabulous.
it's great.
Yeah.
But get to know it. Get educated. Because to me, if I know something and I'm highly educated, I understand where it fits, then those volatile times, those uncertainty, I don't have to have those. I don't have to have the uncomfortable feeling like, oh my gosh, what's going to happen tomorrow, right? It's got to start with the discovery meeting. How do you get the discovery meeting with Stuart? You go to spivakfinancial.com or you can call 480-556-9931. Like, subscribe, share with your friends, pass on this podcast because knowledge is power. Get that certainty done. Make sure you really know your numbers, really understand your plan, and be able to enjoy the things that you do.
Amen.
Here we go. All right, buddy.
Thank
Good
you.
to see you.
Appreciate it, bud.
Securities and advisory services offered through Centaurus Financial Incorporated, a registered broker/dealer member FINRA, and SIPC, a registered investment advisor. Centaurus Financial Incorporated and Spivak Financial Group are not affiliated.